Welcome to episode 14 of the Minds Capital podcast, the show devoted to the growing world of independent sponsorship and deal-by-deal entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Nicholas James and Max Lummis. Today's conversation is with Robert Koven, Managing Director of Leonis Partners, an investment bank focused on middle market technology deals. Robert sees lots of sponsors bidding on the deals he represents, and he's been a sponsor himself, so a great both sides of the table perspective from him today. Nicholas, what were some of your takeaways from our conversation with Robert?
As you said there, Bob has been an incredibly successful independent sponsor himself, and he's had some major exits that he talks about here. And now he's built up a investment bank in New York with more than 100 bankers. So they've built a sizable shop, and he is extremely well positioned to see both sides of the table. So I thought it was fascinating to listen to that. And towards the end of the episode, he goes into how you as an independent sponsor can work together with the sell-side banker in order to position yourself better. And so he underscores that you shouldn't downplay that you're a sponsor or try to be low profile or circumvent the banker, but you should instead go to the banker and say, hey, here's what we have to offer. What are the pain points for the seller? What are the things that nobody else is addressing? How can we unlock value in this particular process? How can we stand out and rather work in conjunction with the banker, which can really create a win-win because the sponsor then can enhance their positioning and how they structure their deal. Because at the end of the day, an independent sponsor can be quite flexible. And the banker knows this, so he can help them and help shape how a perfect deal could look and how to make them even more competitive. So I thought that was interesting. And just to expand on that point a little bit, this is a very sophisticated banker showing you how to do it and how to engage. Unfortunately, I've also worked with less sophisticated intermediaries in my time as a sponsor. And especially on the very smallest deals, you'll come across, on Biz Buy Sell, you'll come across business brokers. And they often act like realtors in the sense that it's more important for them to get a transaction to happen than it is to squeeze out the last 5 or 10% of valuation. And so because that dynamic is in play where they will earn 200, 300, 400K or whatever their fee is going to be if they close the deal versus pushing another 6 months and maybe getting 10% more, they are highly incentivized to work with you almost against their own client. And I've used that to my advantage in the past. I'm a little ashamed to say, but you can notice that they just want something to happen and they will happily advocate on rather onerous terms that I could throw almost anything on the table. So I've seen that side where the banker is not that sophisticated and kind of enjoyed that. But it was also for me insightful to hear that you can actually work with the best bankers that are out there and still create value through that partnership.
Yeah. A lot of the conversation with Robert today was about the banker's perspective on independent sponsors and how independent sponsors look from his perspective and how they can look best. And one of the things that he says is something that we hear over and over again, that over the last, call it 10 years, independent sponsors have gone from the redheaded stepchildren of the deal world to being embraced and accepted. So coming to a process without committed funds is no longer an automatic disqualification. But what he does also say, though, is that because of the growing popularity of independent sponsorship, which he expects will only increase, and the very low barriers to entry to becoming one, there are a lot of less serious independent sponsors. We were in another interview, Nicholas, where somebody called them charlatans, that there are a lot of charlatan would-be independent sponsors. And so if you're concerned as an independent sponsor about what your reputation, the reputation of independent sponsors might be, it's less these days, oh, you don't have committed capital, but more, is this person serious, or did they announce themselves as an independent sponsor last month? And so the prescription for Robert is just to make sure that you are presenting yourself as a serious person, that you have serious capital relationships and credit relationships, that you've done your homework on the deal, on the industry. So I think that bears underlining because apparently there are a lot of non-serious independent sponsors who are getting in these bidding processes and hurting the reputation of the class of sponsors overall. Max, what did you think of your cousin, Robert?
Yeah, well, for one, it was fun to interview my cousin, and it was fun to contribute to the podcast. It was my first venture outside of the preamble, so that was interesting. And I certainly have a whole new respect for very seasoned podcasters. But I thought it was great. Obviously, it's my cousin. I've known him my whole life. I know about what he was talking about. I know a lot more that he's done that he, didn't talk about, other independent sponsor deals and other successes that he's had. So it was exciting to hear him talk. He's full of information. He's extremely analytical. He told you as a sponsor some tips of what to do and what not to do in the process, which you guys just talked about and summarized some of those. But, Dad, don't go around the banker. Use the banker to your advantage. Don't be cagey about where's your capital coming from. It's okay that you're an independent sponsor nowadays. And he says it's hard to even discern, in some cases, an independent sponsor from a traditional PE. There's a lot of overlap nowadays, and there's capital coming into the space, hence, Minds Capital and others. There's capital that's coming in that's committed, that's backing a lot of these sponsors on a deal-by-deal basis. Right at the beginning of the episode, he talks about the sort of the state of the market. We're kind of in a little bit of a weird time here with, the tariff stuff going on. And he's talking about it from a banker's standpoint and in particular related to SaaS assets. But he talks about the fact that the market's a little bifurcated right now with, the best assets commanding really good valuations and selling and being very competitive. And then, the lower class assets that maybe don't have as high of a growth rate. He mentions he's sort of the best asset has 60% growth rate, 120% customer retention, and 40% EBITDA margins, I think is what he said, or something along those lines. And, that's the optimal business that's almost an annuity at this point. So those are still trading at real high valuations, but then there's a lot of other, sort of assets that are not performing to quite that scale that are still attractive, but they're maybe sitting longer on the market, and they're not as the valuations aren't as high. So he touches on the market, he touches on valuation, he touches on being an independent sponsor. He's a wealth of knowledge. It was super fun to listen to him, so I'm excited about it.
Yeah, I'm glad you brought up the SaaS piece, Max, because of course we spend probably half the interview on his perspective on the SaaS market, which a few years ago was as hot as any, and has lost its sheen a little bit. But as you say, bifurcation. So the very best assets maybe are still commanding premiums. If anything, they're maybe benefiting from tariff chaos because there's kind of a flight to quality situation going on. But the remainder of the market has kind of come back down to earth.
That's right. So, and there's some scarcity, of course, right? Those assets that are 60% growth, those are few and far between nowadays. Where 10 years ago, a lot of those businesses were growing rapidly and had good retention, and so they're out there. They're just a little bit harder to find. It sounds like. Exactly. I mean, the SaaS market has been absolutely picked over. So finding one of these incredible business with incredible characteristics in SaaS, near impossible. He says it's not impossible, but close to it. Harder and harder.
Well, let's get to it. This is Robert Koven for episode 14 of the Minds Capital podcast. Please enjoy. Welcome to Meeting of the Minds, your connection to the growing world of independent sponsors and deal-by-deal private equity. We are your hosts, Will Smith and Nicholas James. Robert Koven is Managing Director at Leonis Partners, a New York and London-based middle-market technology investment bank that Robert founded in 2013. That was after an earlier career in M&A at JP Morgan, Lazard, and Lehman. Leonis is an award-winning bank and leader in the domain of mid-market technology deals. Robert brings 2 decades of M&A experience, advising on over 100 deals totaling more than $250 billion in transaction value. He's even done some of his own SaaS deals, which we'll get to. A native of Atlanta, Robert now works in Manhattan and lives with his wife and 2 daughters in Greenwich, Connecticut. Robert, welcome to the Minds Capital podcast.
Thanks, Will. Appreciate it.
So I just hinted at you doing your own SaaS deals. Fill out a little bit more your experience in being a sponsor yourself.
Yeah, no, a number of years back, I had the good fortune of both working in the SaaS community as a banker, but also at a time where, the markets hadn't graduated as fully down market. And so saw a lot of nascent opportunities, had a brother that was working up market in the private equity world, investing in software assets. So he and I day to day were looking at a lot of the market kind of from the other side of the coin at each other. And as we kind of were doing that, he was fortunate enough to get permission from his boss at the time. And I was starting a bank, so had capacity on the bench. And as we looked at certain assets that were probably below the size that we'd be able to sell into the institutional world of private equity, we felt like there were opportunities that could really be shepherded along and ultimately, grow to a size that whether they were going to be, again, recapitalized by another private equity firm down the road or sold strategically, would be a really great place to kind of do 2 jobs at once. So the luxury of being small and nimble at the very beginning was that you do sometimes have that flexibility. So we started doing deals basically as an independent sponsor. At the time, it was called Angle Point Capital. One of the first deals we did was an ed tech business out in Seattle, Washington called Transact Communications. We assembled that business and over a course of 3 to 4 years, did 4 bolt-on transactions with it, and basically grew that business about 5 times, 6 times over the course of that hold, about 3.5 years, 4 years. And we're able to successfully exit that. So, that was kind of the beginning of a number of deals that we did that way. Fast forward the tape, the bank started to grow a bit, and I've had to kind of really spend a lot more time focused on the management of that. Today, with a deal we did recently, we're near 100 folks. My brother, in the meantime, really kind of made a true effort of those early independent sponsor deals, and ultimately has established and set up today what is a true kind of fund. So he's setting up a fund one called Lone Tree Capital, and he day to day manages and administers that. So I have the luxury of seeing it kind of from both sides historically.
So obviously a lot has happened since that early deal that you just cited in SaaS land. We are going to put a pin in that and return to that, get your view on what SaaS looks like today. But before we get there, a lot of other topics to cover. Max, I think we wanted to get a finger on the pulse here.
Yeah. And the other thing I'll just mention is Robert and I are first cousins and have been for our whole lives. So that's the connection here. And I'll just tell a quick little anecdote. We used to, my family would drive down from St. Louis to Florida in the summertime, and we would always stop in Atlanta and visit Robert's family. And pretty much we would, hike through the woods and shoot BB guns, and that was pretty much the extent of it, right?
Georgia was always the gateway state. So we welcomed a lot of people on their way to Florida.
Yeah,
so his family were one.
We did that a lot of times, had a lot of fun growing up. So, and also I've known you for a long time, and I've seen your successes and thought you'd be, a really an exciting and interesting guest for this podcast. But and this is my debut appearance on the podcast as an actual main contributor. So here we are. But Bob, I call you from time to time. I've invested in a few of your independent sponsor deals, and those have done very well. But I do call you from time to time to get a pulse on the market, because I feel like you are really about as plugged in to the lower and middle market as you can be. And so, what's going on sort of in the last month with, tariffs, and obviously the public equities markets dropped a lot. What's your take, and, where are we headed? I know it's a hard question.
Yeah, right. I'd be at the beach retired if I could answer it with a crystal ball. But no, it is a question that we're getting, at every boardroom, every meeting, pretty ubiquitously for the last 3 to 4 weeks. And I think, and we're doing that, while we have assets that are out there that are in Canada, that are in Europe. So we're getting it both domestically and internationally on that front. Our point of view is predominantly in the software and kind of tech-enabled services landscape. So I say, anything here kind of with that is the confines. I think there's a couple things. One, we've seen the private markets remain very resilient. We saw it in COVID. We saw it coming out of COVID. We've seen, really the multiples that were in 21 for the best assets in SaaS or software, if they've got the best KPIs, those really haven't deviated. If anything, they might have even gotten stronger because there's been a touch of flight to quality that started in 22 with the rate infrastructure going up and really hasn't budged since. And so the best assets we're seeing that have the perfect retention, the lack of concentration, the growth, profitability, all the things we all know about. Those are trading quite well. And even in this market turbulence, we're running those types of businesses through processes currently. We're getting very aggressive bids. We're closing actual deals. We're putting assets into market and immediately getting uptake. I think there's been a question as to whether or not it makes sense to run deals through this type of environment. There have been bankers that have pulled processes over it. In certain cases, it makes sense. If your expense structure or your revenue stream is tethered to something that's going to get hit or tariffed, that may make a lot of sense. In a lot of situations, we're not seeing that in software, right? We're seeing that these companies are selling domestically, or they're selling kind of only across a little bit over one side or the other of the border. And in those situations, if they're really strong performing assets, the lack of actual product going into market is creating a very strong demand actually for those processes. So in a weird way, it reminds me a little bit of what we saw probably in the end of the second quarter of 2020 when COVID had been around for a month or two. People had finally figured out remote touch, and all of a sudden the demand was still there for good assets, but the supply had been pulled. And then all of a sudden we all remember 20 and 21. I don't know that we're going back to a 21 type of phenomenon. That was a pretty unique moment in history, but we are still seeing very strong demand. Now, for assets that don't have the luxury of the profitability or the retention, or they've got some sort of, quote, hairiness that you might hear about, those assets have been challenged in the markets really for the better part of 3 years. That challenge hasn't gotten any better in the middle of all this. So I think it's really still a bit of a tale of two cities if you think about just, great assets getting great bids almost irrespective of the time and what the public markets are doing. And the lesser quality, having to really justify what they're doing if they're not kind of in stride with some of those better assets.
Fantastic. Thanks for that, Robert. Yeah. Well, we are, as I said, we're going to return to unpacking the SaaS market here in a few minutes. But one thing that we really wanted to hear you speak on, because the audience for this podcast is going to be independent sponsors. You, as a banker, see a lot of independent sponsors. You're on the other side of the table from them. You're bringing your deals to them. And so we wanted to get your perspective on them, how they present, kind of what you're seeing from the independent sponsor category as a whole. And then we'll double click on that and try to figure out ways that listeners might differentiate themselves.
Yeah, absolutely. I think the classic banker, response to an independent sponsor search fund, historically is probably different than what it needs to be today, right? I think there's an evolution that's been afoot, and it's accelerating, not decelerating. And where we might have looked at an independent sponsor 6 years, 8 years ago and said, well, they don't have the committed capital. Can they really move as aggressively, post a letter of intent, or, can they deploy the resources to do the diligence in a path that will keep up with the rest of the field and then be reliable post bidding? Do they have to then go seek capital post signing a letter? Does it elongate an exclusivity period, even though they might be a high bid? Therefore, do we have to discount their bid for the risk? That is a very classical and typical way of thinking about an independent sponsor within an auction process for a banker. So we historically would pick up the phone when we had a busted process, right? It was, hey, we appreciate you were at the bidding table. It's 3 weeks ago, 4 weeks ago. We found X, Y, and Z. Here's why we don't think it's a big issue, but if you'd like to stand in, do you want to be here? And classically, it was a great solution for what we'd call a broken deal. And that was kind of where you might retreat back to the independent sponsor community. There's been a lot that's really evolved in the last couple of years, really. And the biggest thing I think is two things. One, the sophistication of the talent pool that's coming into the independent sponsor community. So you're seeing that the stagnation of kind of capital on the committed front is leading people to think about leaving that are VPs or principals at some of these private equity funds that have been trained very intelligently over a long period of time, but where, if you're not able to increase the AUM of that fund manager, you're trapped in terms of what you can grow into from a career and achievement standpoint. And so as that happens, and I think that will continue to happen, this is a very challenging fundraising market for the kind of traditional, asset managers and sponsors out there. As that happens, I think you'll see more folks going in. So one, we're seeing and we're expecting more great talent to come into it. Now, the capital world isn't stupid to it, right? And so what we're also seeing concurrent with that is the Grosers of the world and others that are creating dedicated funds to go identify those independent sponsors, much in the way the search fund community did 10 and 20 years ago. This is going a step further. They're not saying, hey, we need you to step out and go run that business. They're saying, look, act like you historically have when you invested your own capital in a committed fund, but here's your chance to go showcase it. And I think because of that, the ability of a independent sponsor to compete in a process is changing, right? And so the sophistication is there. They know how to use the vendors that they used to use, and the relationships with those vendors still exist. So they get their QE provider, they get their attorneys that they used to use at whatever dedicated fund they used to be at, and they pull them into the independent sponsor arena. Two, they also are getting to capital flows that can be deployed much faster. And these aren't family offices they're having to go to. These are institutional capital providers, asset managers, some of them even tapping the public markets at this point, that are able to command capital at low cost of capital and deploy it quite quickly. And so that ability for the independent sponsor to put down a bid and be able to be effective is going up. Now, I still think there's very few people in the banking community that appreciate that. I happen to have a brother that's in it on the fund manager side. I happen to have been around independent sponsors for a while, so I've watched this. But I do believe that, like, in our processes, the way we're treating independent sponsors, fund one managers, is very different than we would have 5 or 10 years ago. So there's one, you've got to be aware of that evolution as a banker. That the next part is, from a independent sponsor standpoint, I do think there is sophistication that a lot of these guys are and have learned at their prior firms. So how do you do it? You showcase the vendor already being there, right? So it's not just, hey, we've got an accounting firm. You're bringing them in to do the QE early at the LOI point where others may not spend that money. Now, that's a little risky, obviously, because of the cost, but if you have the right vendor, they'll work with you. We're seeing them, say, hey, look, we've got a couple of capital providers. Here's who they are. They're ready for this. They're showcasing where that capital is coming from. If they're going to use credit, which some of these guys will, they're coming in with highly confident letters from the lenders, from the banks. So they're acting in the same way that you traditionally see a private equity sponsor act with committed funds. And they're very hard to discern the difference at times. So as they do that, the more they can be sophisticated around that. And I think the more they layer into looking like a traditional sponsor, I think that you're going to see independent sponsors continue to be a bigger and bigger part of auction processes, especially in the mid and lower mid market.
It sounds like, Robert, that, let me make sure I'm correct on two things I heard. First, that you guys are more open to sponsors, but maybe that some of your competitors are still not, that there's still some of that lagging reputation of the sponsor where they're taken less seriously. Maybe not by your firm, but by others.
Yeah. I think that's true. I think, you've got to be closest to the intersection points of the capital pools. And these flows unlock, not in weeks or months, but in years, right? And we're amidst I think you're in a secular period of time where that capital formation of, the LPs that would stand behind an independent sponsor, there's now dedicated capital that's pooling its way in. That may not take, 6 weeks, but over 2, 3, 4 years, I think people will pick up on it. I think we're at the early fringes of that at the moment. Mm-hmm. But I do think it's a pretty encouraging trend for the independent sponsors out there.
Great. Well, the other thing I heard you say, I think, was that a lot of the new sponsors are coming with a lot of pedigree, with a lot of experience, with big networks, and so those, former GPs or VPs at funds who jump in independent sponsor land are likely to do quite well for all of those reasons.
Sure.
But it sounds like maybe sponsors who don't come from such a background with such deep networks might still be challenged, or at least need to do what they can to position themselves to be somebody like that, even if they're not quite like that.
I think to the extent they can, yeah. I mean, we'll see some guys coming out of the operational side, and I think you're going to see more and more operators come back around and realize, wait a minute, capital that used to be hard to get to, and that maybe only the guys that came out of the fund community knew where to go to get it, is now advertised and much more widely available. And I think what you're going to see and we're seeing it in certain parts of the private equity world that is committed side is a growing importance of the operator. And yes, there's a operating partner in a lot of the private equity benches out there that they all do it differently. Some are very ops heavy. Some have a guy they call in once in a while. But I think most sponsors will tell you if they're out there raising right now on committed funds that they're having to put more resources, more time towards operational excellence. And that's going to permeate in a lot of different ways. I think as you see those operators that understand they've driven large performances before, know that there's also capital out there looking for guys like them. I think you're going to start to see them step into the fold of independent sponsors. Now, I think the way they behave in a deal, they may be great operators, phenomenal CEOs. Often those guys aren't always phenomenal deal professionals, right? They've done a deal or a few deals. And so it's really, those are the harder guys kind of get into a routine around how do you live in a process. And I think those guys may have a harder time in a cookie cutter banked process, albeit I think they'll resonate quite well out there with a lot of the founders, the owners, the operators. I think they're going to work really, they'll be much stronger in a direct and proprietary kind of format is my gut, where they can have time to cultivate that relationship and maybe even longer time to get the deal done just because they've got to get familiarized with the capital environment out there.
So maybe the capital providers that are looking to fund some of these independent sponsors that are becoming, more common out there, perhaps the capital provider could bring to some of these operators some of the M&A experience along with the capital.
Yeah, I think in a perfect world that's you'd have somebody that understood how to run through processes if you needed them, but you'd be backing guys and also at operational excellence. We're seeing some of those data points, but there's not many, right? I mean, A, that's a big carrying cost on an independent sponsor, and B, are you really going to deploy that operational professional down the line every time? Because if you do, you kind of lose the leverage ability of creating the sponsor component and sitting over the portfolio companies as opposed to being actually the one on the ground operating at the portco level.
Mm-hmm.
So on that note, where you have a great operator that has a lack of deal experience, but could otherwise do very well running one of these businesses, do you see any pitfalls with that? Where's the risk for that person in a process if they don't have that M&A experience, particularly in SaaS? Are they more likely to overpay?
Yeah. I mean, that's where an independent sponsor challenges the banker the most, right? You get a very patterned set of bids, and somebody comes in some level higher, right? And maybe it's just a hair. Other times we'll see it where it's much wider, and you really do have to look at that bid. And most owners are going to look at that bid and say, how do I look away from it, right? Now, the challenge, of course, is they may have just simply overbid, and when they go back to the capital providers who are intelligent and have their way of getting to others out there behind the scenes, do they reformulate and have to go back and say, look, our capital really isn't there unless we get this to a different price, and of course we can hang it on diligence or whatever we need to, and then they've got to come back and either readjust value or walk the deal. That's a hard thing, and that's hard. It's not just an independent sponsor. That's hard in any bidding process to sort out an outlier bid. It's even more called to the floor when it is an independent sponsor, candidly. And so I think, there's an element where, if you're those types of outlier bids, it's trickier for sure. Now, I can give you examples of guys that have won in those situations over the last 6 to 18 months that are real, right? And sometimes they were 5% high. And I was talking to another banker the other day at a firm, and they had a bid that was about 20% higher than the field. Worried they were going to take it, and the independent sponsor went out and found a private equity sponsor that ultimately backed the whole deal up before it got hung. So, it comes down to can you find the capital quickly enough to keep the banker at bay?
And when you've seen these examples of a sponsor outbidding and overpaying everybody else, was there on the back end something that you saw them do that enabled that? Did they have some special insight? Were they operationally heavy? What was the end of the story there?
Usually when I see it, the outlier I mentioned a minute ago, I think was just an overbid, candidly. There are other times though where it's very much a different story, right? They've got a unique angle on the business. I can give you examples we've had over the years where people already have a pre-existing asset, or they've done a lot of work in a vertical historically, and they're intimately connected with the ecosystem, right? And they look at that and say, look, I know where there are levers that others don't. And they've unlocked that value. And I think when you get that type of sponsor, like that's what you're hoping for, right? As an investor. I And there are those that are out there that do stay very tight in their swim lanes, and would be, true opinion leaders, experts in their own kind of ecosystem. And when you see that type of differentiated bid, you go, well, wait a minute, he used to operate X, Y, and Z. He knows all the relationships. He knows where to go to get the savings or the growth. And you can real quickly just figure out why they could be at a different price and justify it. And those are easier to fall into because you can see the logic.
So everybody loves the recurring revenue of the SaaS model, the high margins. It's obviously super attractive. If you were an independent sponsor coming into the space, looking to do a deal, I mean, it's like your dream business, right? Not a lot of employees in most cases. Do you feel that, has the industry changed over the last 10 years, say, to where a sponsor could kind of luck into potentially a SaaS deal versus maybe now? Has it become more competitive?
Yeah, it's evolved a lot. Years ago, we used to tell, founders of firms, hey, if you're under 10 million of top line ARR, there's not a lot of institutional capital out there for you, even if you're selling, 80% of the business. Now, caveat being if they're growing 100% or something, kind of venture-esque, but there wasn't, this world of growth equity, right? That really has seeped very deeply into the software ecosystem over the last decade. Really was pretty nascent. It was really buyout guys on one side and venture on the other, leaving a big swim that was, companies that were 3 to 15 million of ARR. Above that, you kind of got back to buyout behavior. And what we've witnessed over the last 5-10 years, and really accelerated in the last 5, were a couple things. One, you had a number of folks that, really were serially rolling up businesses. PSG is a great example of that, right? They'll go through a vertical and roll up 20 companies at a time. That was one part where they created a lot of direct sourcing, that would go all the way down, to a couple $1 million of ARR. So all of a sudden, people were getting called by the sponsor community more and more, and also you had the development of the growth equity world concurrently with that, right? So you had these guys, they could look at minority, they could look at majority, they could get down to 5 or 10 million of ARR. Many of those guys had funds that were 500 million, $750 million, and ultimately would put together direct teams to call into that ecosystem of founders and entrepreneurs. And so the pressure on that ecosystem grew. And at the same time, the bankers watching that kind of going on came downstream with them. And so you really took an area that had no vendorization and no capital 8 years ago, 10 years ago, and have put a ton of bankers in it that educate, that also, there's to every private equity guy's non-delight, the view is the banker tells them 20% higher than, or whatever the percent higher than it ought to be in terms of valuation to win the mandate. Now the buyer in their mind has to compete with this false perception of reality. Who knows which part of that's true? Both sides bicker about that. We argue they're trying to get them on the cheap, and if it wasn't so bad, why wouldn't they be selling their own assets? On the flip side, they're going to argue that they've been over, quote, sexed up by the banker before they get out there. All that's going on concurrently, and the amount of educational material from a marketing standpoint produced by both sides of that, bankers and private equity guys, targeting the founder, targeting the entrepreneur, has gone up dramatically. So, 8-10 years ago, a lot of guys might be on a sleepy lifestyle 3 to 8 million ARR asset with very little education, knowing their EBITDA was only 20% margin, and they were trying to put an EBITDA multiple on something that we knew could price for software. The reality is, fast forward, there's very few founders I find anymore that think on an ARR-based business that if they don't have a lot of profitability, that they can't get paid a revenue multiple. In fact, we find the inverse, which is hard to deal with. A lot of guys haven't figured out that if your growth tapers, you really need to bring up profitability to get to the multiples that people like in that industry. So there is always a little bit of a buyer or seller kind of valuation gap, I think, in a lot of spots. On the perfect assets, there's not, but and it's not perfect. Is dealing with that. So I think that era of finding that or stumbling into it has gone down substantially. Now, it doesn't mean they're not out there, and it will occasionally happen. Where we think it's most likely to happen are where you find things like, embedded payments or embedded insurance or factoring or other things that you can get to along a stream of ARR that the founder, the entrepreneur, is too late in the cycle to want to monetize. They're too tired. They don't know about it. They don't have the expertise. They can't make the investment to get the expertise, whatever it is. And that sponsor may have just done something in embedded finance that can be ported on top of that software. And that unlocks, or a consolidation play will unlock. And that's where the sponsor, we think, can actually add a lot of value. And I think you've got to come at it from those operational enhancements or that M&A enhancement to really be able to say, you know what, we can get to a valuation that makes sense, and then therefore also get returns. Because the idea of just grabbing a multiple arbitrage now, I think I wouldn't underwrite it a model. I don't think anybody does.
So the old, let's grow ARR organically, throw more sales and marketing at it, and then sell it to the next level. It sounds like it's gotten more complex.
It has. There are times where it isn't, right? You can catch somebody that, hasn't done that but still wants to get multiple, and you look at it and say, well, the unit economics and the sales efficiency, when you look at retention and LTV to CAC, warrant spending more on R&D, but they just don't want to bring down their own salary, or they don't want to bring down some buffer of cash. All those are fair when you're 100% exposed to an asset. When you own it institutionally and you're not that exposed and you're diversified across multiple assets, you'll absolutely say, you know what, we can do that. We will take that risk. And we might even bring in a small credit facility to allow us to smooth some of that out. And that's the sophistication that not every entrepreneur has. I think where they have been educated highly is on revenue-based multiple behavior out there and kind of where things, quote, trade in the market. That's probably where the education has gone. And I think where the lack of like finding the needle in the haystack or the diamond in the rough is probably gone down a bit.
So given how much more competitive it is, the expectations of owners and sellers, the high expectations that they've all been educated now that they should expect multiples on revenue, does that leave space for sponsors getting into trying to buy a SaaS that don't already have some way in, some toehold, some track record, some portfolio already? It sounds like what you're describing is a very competitive market.
It is. Well, and I think software is, because to Max's earlier point, like people love, pipeline toll road behavior, right? Like it keeps flowing through, and as long as it retains, you've got an annuity. It's a cost of capital function, right? Well, like as you drive cost of capital, more capital into it, you're driving down the cost. The value of those annuities are going up, right? They're the inverse of that kind of equation. And so it's there. I think you have to find a place where you've got either a right to win, it's something in your track record, something that you've done historically, some relationship you have, some arbitrage you see, to really be able to step into it, right? I think the idea of, hey, I'll just take it and grow it and eke out a return, I think the pricing's eroded a lot of that. I don't think that's that dissimilar from most industries, right? I think it's just a commoditization cycle that we're running through.
And what about technology-enabled services, which you said was another kind of the other side of your business? Maybe say more about what that is, define that more, and then give us a snapshot of that market.
Yeah, we've got a number of bankers that cover kind of for us what we'd call business service or tech-enabled services. More precisely, the way we might think about that is one, what is the tech that is enabling, right? Is it truly tech, or is it just a bunch of humans that are offshored that when you get into diligence, you find out that's really going on? Or is there actually some technology that's been proprietarily built that is really allowing you to still deliver with humans, but at a higher gross margin? And as you look at a lot of the sponsor world and the evolution of the software side, what we are starting to see is a lot of the guys you'd classically think as software guys are starting to make that move and look at the tech-enabled services paradigm. And is there an AI argument for it where, look, you can design internal technology at lower costs and cheaper costs, and therefore you can have more of it. And as you have more of it, you can use less humans and therefore make these tech-enabled services more scalable, potentially, right? Where, so I think there's a little bit of if you're fearful of the AI trade against software, right, which is that you could build software much cheaper, faster, therefore the moat's lower, the natural place to go is a place that benefits from it. So you're watching this pendulum swing a little bit, in our opinion. As a firm, we're investing there. So, I would, in terms of people and time. So I would tell you, I think you're going to see more of that. We're watching the multiples. They've been relatively stable in a lot of spots, even through the volatility. But they are, they can sometimes come with a little bit more clunkiness in the revenue base and concentration. So, all these businesses have their challenges. That's some of theirs. But we are seeing people shift into it. I do think you'll see people continue to push into that because, again, that recurring theme of revenue is there. It's just not as scalable at a lower gross margin. And so as you think about the ability to grow the bottom line fastest, you're still probably in most software SaaS worlds likely to be at a higher gross margin, so every dollar falling and scaling that EBITDA more quickly. But these are still very asset-light, scalable businesses much in the same way that software. There's a lot of complexity to them as well, right? So there's, and we often find the guys that do software really intelligently don't know services as well, and vice versa, because they're a lot of times the toggles to optimizing those businesses seem very different to the banker, at least.
Robert, one of the things that we've been speaking around on this, and that we hear a lot in our conversations and see ourselves in the market, is just the evolution of the independent sponsor space, how it's much more mature, much larger than it was even 5 years ago. Always an interesting question. And there's much more infrastructure, much more capital there for independent sponsors, much more legitimacy. They're seen as more legitimate. On the other hand, also, as you touched on, there's a lot more independent sponsors coming in. So if you had to net it out, better or worse to be a sponsor now versus 5-10 years ago?
I think it depends on who, right? I think if you're somebody that could command capital and had a strong network, that was an advantage for you, right? And so now as that capital floods in, that advantage is being eroded, and it's allowing folks to get in, right? So for somebody like that, this is probably a harder environment. Probably no different than sponsors that were established in 1990 felt about where the world was in 2020, right? And so I think, if you were in that network and already had 3 portcos standing, you probably look at this and go, well, that's not exactly great. Now I've got 15 more guys to compete against. Conversely, I think for the guys that haven't had time to establish that network, that are getting in, that have either been great operators or trained professionally, that don't have time to go learn the world of fundraising, and whether you're doing it for a fund or whether you're doing it for an independent sponsor, you're still fundraising.
Yeah.
And if you don't, and then that's a learned skill, it's a learned network. The easier that network is to get to, the faster those guys that are coming in can run. So I think for the young up and coming generation that are nimble with technology, that have been very aggressive and forward thinking in a lot of these shops, taking some of that thinking with them, it's actually an advantage. Now, so again, it cuts both ways. They're still competing with each other, which is a disadvantage. But again, if they had to go spend 3 years figuring out where to raise capital versus spending 3 months, that's a very different ballgame in terms of where you are in a career and a lifetime. So I think what you're going to see is it's going to allow a lot of the younger generation and a lot of the operators to come in and actually have a very different playing field than they probably would have 5-10 years ago.
And when you talk about learning the skill, building the muscle of fundraising, even if it's fundraising for a single deal, anything that you see sponsors or early novice sponsors classically do wrong? Anything that you could tell the audience to rookie mistakes?
I think there's a little bit of fear of transparency. I think often the more cagey somebody gets about where their capital sources are, the more your antennas kind of go up just naturally, right? Versus the guy that says, look, I'm calling in whoever, here's a piece, here's the credit committed, or at least not even committed, but highly confident letter. And by the way, look, here are the 3 main LPs, or the 3 main groups that stand behind us. We've done 2 deals before with them. We're not that scared. You want a direct line to them. That the amount of disarming that pressure in the system on that front is pretty dramatic. So I think in some ways people often hide behind it because they fear this, like, oh, I'm not a committed fund stigma. And I think because the capital is coming in, I would encourage people, the more time goes by and the more that capital becomes more easily available, point to that as the source and say, hey, we've been around them. We've shown them 14 deals. We've been through 2 committees. That's the type of stuff that would give a banker or just a really savvy seller that's not banked the ability to kind of say, all right, well, that sounds a little bit more legitimate. I think I can see it. The opacity is what makes it hard.
Okay, so don't try to dance around the fact that you don't have committed true fund capital, and instead point to who you're talking to and just lay out where your capital will come from.
Yeah, that's right. Well, I mean, because look, if we're trying to figure it out, somebody's trying to hide it, we can try, between what's publicly available, whether it's, PitchBook, CapIQ, SEC filings over 100 million of AUM. There are so many different ways to triangulate that before you even pick up the phone and call somebody where the guy used to work to figure it out, that you're better off just shooting it straight. You'll only build credibility.
Great. Well, we're getting toward the end here. We still got you for a little bit, Robert. Wanted to hear about the story of one of your SaaS deals. But Max, am I leaving anything else on the table on some of our other topics?
We've talked about being transparent in terms of where the capital's coming from. We've talked about the sponsor having vertical industry experience. I guess if we bring it down to a little bit more basic fundamental level, what are some attributes and some characteristics of sponsors or just buyers in general that make the transaction easier, that you enjoy working with, that the seller gets a good experience with? What's the best practices, I guess, for a buyer? Some things that come to mind for you.
I think one is showing you've done your homework, right? And that's not even just the banker. When you talk to the clients and ask them why they enjoy meeting somebody, usually the first thing is, hey, they really know my industry, or they clearly have got a game plan of how they think they can build this business with me or after me or whatever it might be. They clearly had relevant experience. Anywhere where you can highlight you've done a lot of work, right? Or pick up the phone, try to figure out what customers are saying. There's certain things that you can do that innately educate you quite quickly. I mean, heck, there are tools out there if you want to use AlphaSense or GLG. Like, those are expensive, but if you are have the resources, you can procure them. And so you can get very intelligent on these businesses before you ever step in the room. So I always try to, when I'm talking to guys, say, how do I get in there? Like, one is just the passion for the business and the industry and the domain expertise. That's the easy one. It's easy from the standpoint of you can do it if you want to spend the time on it. I think the other is just, really, especially in the independent sponsor side, if there is a unique angle, right? Hey, I used to operate in this vertical, or, we owned a portfolio company at my prior firm, and here's the story why I left. You can kind of try to, especially if there's no banker in the room, try to actually get to a level of identification with the guy selling the business. Even with a banker in the room, we still always open up the time, if you get to management presentations or whatever, to say, hey, give a little bit about the firm, the background of the team, et cetera. So I would never underweight that. I think people make really strong, good and bad first impressions, especially in bank processes where you're getting stack ranked against other people. So I think that's one. Sometimes the sophistication of your vendors is a tip off, right? And so, like, thinking about, if you've got an accountant, have they worked in SaaS companies, right? If you're in software, don't bring in oil and gas.
If the accountant's asking what ARR is, that's probably not a good sign,
exactly.
Right?
So, like, there's certain things that are kind of giveaways, like, this is not good. But it's things like that, Max. It's some of the softer stuff that I think, I'd probably be trying to bring to the dance.
This flip side of it's really intriguing to me. Any more don't do this behavior for buyers in a deal? Like, what are some behaviors or some tactics that frustrate you?
The easy one's going around the process. The smart sponsors will say, hey, do you mind if I reach out and say thank you? And that thank you probably gets a couple follow-ups we won't see, right? Like, but we know that they've done it and we're fine with it. What doesn't work real well is when somebody's like, oh, I'll go around the backside and try to get information. It always comes back to us. And unless the guy really dislikes his banker, and I've seen situations where it does sometimes happen. If you lose trust as a banker, sure, they'll go direct. But as long as you've maintained trust, everything that you do on the backside is going to become channeled back, and you're either going to get played, and they'll both play stupid, even though they're totally in coordination, or it's going to upset the owner. Like, why does this guy feel he's so special, he should jump out of line? So I think there's an element, and this isn't the banker or me saying it's actually to truly try to help, of respecting the process can go a long ways. In fact, if I would almost say it the other way, use the banker. Hey, what can I do to differentiate? What can you give me views on pricing? Like, where do I need to be? And sometimes they'll tell you, and sometimes they won't. What outside of pricing wins? Do they want structure? What do they really want? In terms of not just sticker price. You can ask some questions of the banker and start to see where the pain points are and the levers are, and sometimes it can unlock a bid. So I think not being afraid to engage the banker is intelligent.
And Robert, why are sponsors circumventing you sometimes, or trying to at least?
Sometimes you're just frustrated, and it's a natural reaction. I've got family in the industry. There are times where I'll talk to them over, a dinner, and he's like, God, the banker's walling us out or boxing us out, and just kind of, and they're getting boxed out because somebody else is outbidding them. Or they're working through another bid, or maybe their numbers aren't compiled yet and they want to give an update. But the answer is, it could be good or bad. You won't know. The reality is there's a reason. The banker isn't accidentally forgetting to call you back, so, and the owner isn't practically like saying, it's okay, banker, like, treat these guys like dirt. When you're going to do that, usually it's a very coordinated conversation before you put somebody in a penalty box or hold them off to the side.
Is it useful for the sponsor in a situation like that to ask you point blank, hey, I'm getting radio silence here. What'd I do wrong?
Yeah, I mean, that puts you on the hardest spot as a banker, because if you're really giving them radio silence, now you ask yourself, God, how bad do I want to hurt this relationship with the buyer? Am I going to see this? We live in a repeat game, right? So that as the banker, like, God, it's stretching it pretty thin. They know we've got to run a process one day, maybe their asset. So you tend to hold, but if you're going to break, that's the easiest way to kind of start to wedge it a little bit. Like, look, do we miss the mark? Do we not do something? Do you have 2 minutes?
Okay. Good stuff, Robert. Okay. Now, take off your banker hat and put back on your sponsor hat.
Yeah.
And could we hear, was it the deal that you cited at the top?
We can talk about Transact. Yeah, that's fine.
It sounded like it had an incredible return. So yeah.
It did. Yeah, I think it was a 9.
Yeah. What year was that you bought that? I was trying to remember.
2016. It was October 2015.
I think it was one of the first independent sponsor deals I had ever really even seen.
Yeah, we vertical SaaS, so it was in education. It was all around compliance for school districts, right? And if you wanted to get federal money on certain pools, you had to show compliance. That had to be run back up, through the states and ultimately the federal government. Back then, a lot of that funding came out of what was No Child Left Behind, that became ESSA. It's gone through several iterations since the 60s, really. It started out, that was originally done with, CD-ROMs into schools, and then it became, diskettes, and then it became the web. But ultimately it was forms. It was a form that basically was for a host of things. It could be, hey, the kid's got, lice in school. They've got to notify the parents. Here's a stock form for it. Fill it in, boom, pushes it to all the parents. That business at the time was just doing effectively that, right? So that could have been school lunches. It could have been anything that you needed to notify a parent about as a public school in the U.S. We looked at it and thought there were a lot of natural places to expand it. It was a very fragmented market at the time. It's coalesced a fair bit since. We were part of that, actually. But, we very quickly identified probably about 100 other assets that were out there that were kind of tightly adjacent. We screened that down to probably 20 to 25 that we thought made a lot of sense. And really over the next 3 to 4 years, spent time effectuating an M&A strategy. We recruited in a CEO that came on day one as we acquired the business. He'd been in the consulting world. We knew that we wanted to do some M&A. It would be important to get a lot of the integration done properly. He had been in an integration group inside of one of the large 4 consulting firms. And we effectively said, hey, look, please relocate from New York to Seattle. Come on day one. We'll put together a plan for you. So we pulled him in directly. And then he started to basically, after day one, build out and replace the senior team. Fast forward, we were about a year into the hold and started making the acquisitions. We acquired one called Cayenne Systems. It was all after school forms and permissions, 21st Century Grant, and a number of other things that kind of cover that pool. Very, very natural adjacency. We went from there and acquired another one called Right Labs that was out of Alberta, Edmonton. So way up north on the other side, took us into Canada. But more importantly, it was again kind of events and other things around the school. Same kind of folks procuring it. And
how big are these businesses? How big was the platform and then the others?
They were probably at the time we were buying these for a couple million a pop. A lot of that was done without ever calling another dime of capital. So as you think about the constraints of an independent sponsor, and even us, back then, where raising money was, looking back to that point I made earlier about, hey, do you have a network or not? Raising money was not easy for guys that were in their late 20s to early 30s with a moderate at best network. So we didn't really want to go back to the well as it related to equity. I
would classify myself as sub-moderate probably at that point in time.
It was friends and family. So, it at that point, like we said, what, all this has got to be done in a very capital efficient manner. So everything we did was either it was credit finance or structured. And most of that was done with credit. So over time, we got to a place where we knew we'd, taken the balance sheet as far as it could really go without recapitalizing it. And at that point, we looked at potentially selling the business in an auction. Right as we were about to do that, Polaris Partners out of Boston kind of came in, had a vision for how they could take that business to make it 3-4 times bigger. We looked at it and thought it'd be great, but at the same time needed the capital, so we politely bowed out at 100% exit. And that, at the end of that, we, basically handed it to them. They've now taken that business, and that's probably 2.5 times bigger than when we sold it to them 4.5 years later, and we actually cover it.
And Robert, remind us what your numbers were during your hold.
I think we started at $2 million of ARR, and we took that thing to about $7 million. And
phenomenal.
Yeah.
And so buying in 2015, that would have been, SaaS was already,
SaaS was
maybe
known.
It wasn't white hot
but
yet,
SaaS,
but it was getting hot.
Yeah, it was warm.
Yeah.
But back then, I can remember looking at SaaS assets that were probably 3-4 times revenue, and it was even lighter than that. That today would trade at 4 to 5 times at least, maybe 6. So there's been a pronounced. It doesn't sound like a lot when you go, wait a minute, 3's gone to 5. That's still a 66% run up in that period of time on multiples. So are they exactly that? Maybe not, but there's probably been, if you look back at like SaaS indices and stuff like that, you've probably seen that much of a run up in kind of what we'd call kind of like the floored multiples, of kind of where most of these businesses are going to trade with decent KPIs.
Mm-hmm. And you were able to get into the deal because it was so small. It was off the radar of any of the big players, and it was still early-ish in SaaS. Yep.
Totally.
And Robert, one thing that we've seen in a couple of SaaS deals is actually some disagreement about valuation. So sponsors, maybe they were the top pair, some sponsors that we've talked to. We, after consulting with you and others, decided that their valuation was a little rich. I think the argument for people thought that their valuation was too rich was that the multiples have come down a little bit, whereas they felt that the multiples had stayed in the same place. So I guess what I'm saying is, for not the premium assets that you've already told us about, but for the kind of the sub-premium assets or the still smaller businesses, it feels like there's maybe more ambiguity about where price should sit in that market.
I think there's still a little bit of a buyer-seller disconnect. Structure is helping with that and ameliorate some of that. But I think there's, at times, this ubiquitous view of everything should trade at 10x revenue or 5x revenue or whatever it is that somebody's anchored to. And that can be true, right? I mean, we absolutely are selling things for double-digit revenue multiples right now as we speak. Now, I can tell you that they're 120% ARR, net retention. I can tell you they're 95% gross. They churn, 2% of their customer base a year. When you look at the unit economics, they're 3 to 7 times LTV to CAC. They're 85% gross margins. They are 20% EBITDA margins. They're growing 60%. That will trade at an astronomical multiple if there is no customer concentration and there's large TAM. So if you have one of those businesses out there, you've got a gym, enjoy it. There's not many of those, right? That's what I describe as probably top decile in the country. When you come back off that, and SaaS Capital and others put out good reports on this stuff. But as you kind of walk down the line of some of these KPIs, there is real gradation and degradation of multiples, right? If you're growing 10 or 15%, break even, that's not a 10x multiple business. Unless somebody has to have it for some other reason, they can immediately optimize the EBITDA. Even then, I still question whether those people that have it think they'd really have to pay 10x. Wouldn't 5 probably suffice if the market was at 3? And so, when you set the banker hat down for just a moment and have a very level conversation, you've really got to be honest, intellectually honest about what type of SaaS asset do you have, right? Everybody has a house. There's houses that sit on the beachfront of the Hamptons, and there are houses that sit and are falling down, outside of where I grew up in Atlanta. They're very different things, but they're both houses. And so a SaaS business to me is, I think there's been a bit of a forgetfulness about what is it in SaaS that made them so attractive at the beginning. Why did capital flow prolifically for the last 5 to 10 years in that direction? And to the point earlier in this conversation, it was the recurring revenue. It was the scalability of it, which was measured in gross margin or bottom line profitability or lack of CapEx. It was retention that gave it an annuity value, that cash flow. Those are the things that made anybody that understood annuity value and the value of origination look at it and say the fundamental value is pretty dramatic. We can pay in here fairly interestingly or aggressively and still have a heck of a return if we do it right. And I think people sometimes conflate having a recurring model with being a recurring SaaS model with being a good recurring business, right? If you've got 80% retention in an environment that only gets 60 because it's SMB and you're running at 80, that's interesting, right? If you're getting 80 in a place where people and competitors are running 100, that's actually scary as hell. So as you think about it, there's a relative side of this thing. There's also the side, in my opinion, of you can't be churning 40% of your customer base and say you're recurring revenue. Not in the way a guy keeps 90%. And so you may have 80% growth, but you're having to replace that customer base every year and eventually all large numbers are going to catch you.
Yeah.
So there's all these balancing factors. And I think that's where people are getting a little bit, there's a lot of down market bankers that are just going to tell you, oh, it's SaaS, it's whatever X multiple. And that's not really true. You've got to get back to what are the fundamentals driving that business. That is the way value has been done in every industry since the beginning of time. So
Sure.
It's not to say it doesn't run up with 20, yeah, but I think there's a hard reality to grasp out there for a lot of folks. Where in 21, I think the biggest difference isn't that the multiples came down; it's the multiples for some people came down, some businesses came down, and so out there's still guys getting that, and people only talk about the high ones. They'll forget to tell you 30% of it was in an earn-out. There's a lot of things people forget when they're at the country club talking about the multiple they got. Structure's a key one of them. What they took home net's another. So as you think about that, I would just caution people to be wary, of what people are saying things go for, and ask the secondary and tertiary questions of, well, what if I really look at this, and what if that's true? And I'm a very positive bank. We'll be out there pushing as hard as anybody can. But I can tell you, just practically speaking, you have to self-assess before you let the market. And the other thing I'll commonly get, and I'll finish, is, hey, I'm getting 300 phone calls a day. I'm like, that's cool. You know what? Your competitors in market, is it up from 150 last week? Well, yeah, it's up 2x. Well, that's why, because people are doing competitive calling. They're calling into the ecosystem to learn what they can bolt on or figure out information about the company they're chasing. So that actually stimulates action a lot of times in sub-verticals. But
competitive calling?
Yeah, so you're calling in, go through a SIM, a confidential info memo of a banker. He'll list 5 other competitors or smaller bolt-on opportunities. So the private equity guy goes to committee and has a memo. Once he got in there, his next 5 opportunities, what he's going to bolt on. Or could he even get one of them under letter of intent? Now he can bid more aggressively. So a lot of times when people are like, hey, I don't know why all of a sudden I'm getting 40 calls. I'm like, well, did you know your competitor's in market right now?
Interesting.
The other thing I'll get is, even when there's no competitor in market, is, hey, I'm getting tons and tons of calls. I'm like, well, let me name the 14 firms. And we'll go through and get 12 out of 14. And but here's 8 more that'll call you next week. And those guys have direct calling efforts. There's nothing wrong with that. It's helpful. And they're doing it trying to find proprietary deal flow, which is great. Good for them. But a lot of times we get founders that conflate an associate or a young VP calling in and getting very excited about the asset and showing good passion because they've got a good sales acumen, and taking that as real interest. Real interest is when you've got the partner on the phone telling you he needs real data. The other thing we're seeing out there, this will blow some people's minds, we're seeing sponsors that will throw out a letter of intent without getting actual physical financials. Like, hey, I think I'm here and I'm here. Fine, here's a letter of intent. If it works, calls, we'll dig in. So people are that aggressive in certain spots.
Wow.
Owners will take that as oh, I know I'm worth whatever that multiple is on that piece of paper. Well, maybe you're worth more. Hell, maybe you're worth less. Who knows? Because nobody's done the homework. And so the level of interest is only as good as the data that's being fed to inform that level of interest. So the one thing, as a banker, I caution a lot of guys, whether I'm working for them or trying to work for them or just being a good friend, is don't confuse interest with bona fide interest, with knowledgeable interest, because that definitely is going on a lot more in this market than it was 5 or 10 years ago.
And Robert, for the double clicking on the actual quality of revenue in a SaaS business, give us those 3 or 5 KPIs that we would be looking at.
Look, the first is going to be, I would say, just retention, and within that, I would call it gross and net dollar, along with customer level retention. Most, unless you're volume based or payments based, most SaaS businesses, those 3 metrics will be very stable and easy to measure monthly, quarterly, annually, based on sales cycles, based on seasonality, based on a host of things, but generally pretty easy to calculate and measure. Those will be super core. That's the stickiness that's going to drive the LTV, the long-term value of the customer. After that, you're going to look at your customer acquisition costs to figure out how properly, is capital flowing into obtaining efficiently, I should say, not properly, efficiently, is it flowing in and obtaining a customer, right? And that informs how much gas you pour on things. So a lot of folks will look at that as part of the health of the business. So the retention is at the top of that. The gross margin's right behind it. That's the scalability. If you've got a 80% gross margin and $8 out of $10 flow to the bottom line every time, you can scale that business much faster than something that drops 5 out of 10, right? So scalability matters. People classically don't measure cost of goods or cost of sales as entrepreneurs tightly until they get big enough. That always is a point of consternation for folks when they think they're 85%, but they forgot to allocate something and they're 75%. Things that you should keep an eye on. Bottom line profitability right now is in vogue. If you're not growing north of 10, 20%, I'd say 20 probably, but if you're not growing north of 20%, you need to figure out how to get profitability. It's really, really somewhere between 15 and 20% we're seeing is like that bottom threshold. Like the idea of burning cash and growing 15% is very out of fashion right now. If you're going to grow 15 or 20%, figure out how to get to an optimized SaaS margin. That might be as high as 40% in some cases. So again, when people are thinking about efficiency, that's part of it. So those 4 or 5 kind of financial metrics then, would be first and foremost. Right. But then you've got to look at TAM. Like, is there a lot of market here? What are the secular trends of it? Those are going to be critical too.
Right. Fantastic.
Hey, Robert, just taking a little bit of a segue here. How important from an investor standpoint, I mean, you're obviously a banker, but you're an investor as well. Sure. A lot of the audience is going to be comprised of investors and sponsors. How important is the entry multiple in terms of the overall outcome of a lower middle market deal as an investor, in your opinion?
I think it's going to depend on the type of investor you are. If you're coming from a world that is more buyout and traditionally, using either leverage or kind of growth at a reasonable price, feel kind of equivalent, but like is paying a little bit less, that entry multiple is going to matter a lot to you. If you're coming more from a growth world, it'll still matter, but it will matter probably a little less, right? There's a view of how you're going to get your exit return profile. And to the extent you're more of a growth oriented investor, you're not going to lever it. You're looking for things that are growing north of 30 or 40%. That, to the extent you can prove out the stickiness of the revenue and the forward visibility around some of the pipeline, there's a willingness to move up in value and multiple because you've got conviction and confidence around it, and you're also looking for that growth to engineer your returns. If you're looking at things that are growing 15 to 20%, 25%, that entry multiple is much more sensitive to you. So depending on the type of investor and what investment you're looking at, I think it's probably going to vary. I think the other thing people are thinking about in that paradigm too is this business going to be, when you exit, underwritten to an EBITDA multiple or a revenue multiple? And if you're thinking about an EBITDA multiple underwrite, then your entry multiple is probably becoming a lot more critical to you because you're trying to either figure out how are you going to either scale EBITDA margin to something that makes sense on the exit, or how are you going to get growth there, or how are you going to use leverage to get there? There's only so many ways to get the returns.
I realize a lot of your deals trade on ARR multiples and their SaaS deals, but in terms of multiple expansion on exits, what are you seeing in terms of just general breakpoints, be it revenue or EBITDA? Yeah. When does multiple expansion happen generally, in your opinion? When is it reasonable to kind of forecast that at a model? And what are those levels sort of in the lower middle market, in your opinion?
Yeah, I think we see different scale points, right? So like we'll see assets that are 5 to 10 million of ARR that would, if they were 20, would trade at a very different multiple, right? So, somewhere we classically have always said somewhere around 10 is one. There's probably another 20 or 25. There's probably another yet at 50, and then it kind of turns into a different game. So there definitely are those. Now, I think for an independent sponsor, a sponsor coming into an investment, I think most will classically say, hey, we're not going to model the multiple expansion. I think there's so much challenge from the investor, the LP community these days, especially if you're looking at eventually raising a committed fund where they're going to take all these case studies apart. I think you're going to be hard pressed if part of your underwriting was assuming multiple expansion to get your returns. I think most guys are looking at it and not making that assumption, but saying that's upside if you get it. But in a base case, can we, without expansion, get to the return profile we need?
Robert, thank you for a walk through the intersection of sponsor and SaaS land. Fascinating. That was particularly at the end there, really, really helpful. The firm is Leonis Partners. What's the URL?
LeonisPartners.com.
Easy enough.
Yeah.
We will put a link to that. Put a link to your LinkedIn if people want to reach out. Is that the best way? Great.
Totally.
We'll have
fine.
that.
Yeah.
We'll have that in the show notes. And we thank you for coming on the Minds Capital podcast. Robert Koven.
Thank you guys for having me.
Hope you enjoyed that interview. For more like it, subscribe to Meeting Other Minds wherever you listen to podcasts. You can also watch us on YouTube. And check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. Minds Capital invests equity in independent sponsor deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about partnership opportunities and future fundraisers. See you in the next episode.